So let's talk about SoFi. SoFi is up 30% today. Today alone. Absolutely insane, but the stock has been really getting the shit beat out of it over the past year. If you're somebody who bought in at $28.38, you are currently down 71% in the past 1 year and 5 months. And at one point, you're down 85%. But I was looking at potentially buying some SoFi at those lows down at $5, and I would be up 63% in the past couple of weeks. What I want to do is analyze and take a look at SoFi stock and explain one of the main reasons why I am not buying this company long term. Now, this video is not going to be specifically going over what this company does. If you want one of those videos, they're out there. I haven't really seen many people go over the finances of the company and giving a rough valuation of what I think the company's worth. And that's what I want to do here. So hit the like button, subscribe. Check out our Discord down below. It's completely free. You guys get access to free courses, free live streams, free seminars, free webinars, as well as some free trades. One of the free trades that I ended up giving out this week alone was a $1,000 profit on BBBY that happened very, very quickly. About 10-minute trade. And then last week was an XOP trade worth $430. Link is in the description. 95% of traders fail. I don't want you to be one of them. Now, from a fundamental investing standpoint, let's take a look at SoFi, and I'm sure that I am not going to get a lot of love for this video, but please remember, don't listen to me. Like, I'm giving my ideas and my thought processes, but if you truly believe in something, don't let me or anybody on the internet sway you. Use proper risk management. Always do your own research. Always do your own due diligence. For me, when I'm looking at an investment, especially in the economic landscape that we have right now, I think that there's a huge chance for a lot of companies to go bankrupt over the next 2-3 years. And I don't want to be investing in companies that are burning a lot of money. So the biggest reason why I didn't get back into Uber in the past couple of days, even though I love Uber so much, I just don't want to be in companies that are burning cash, and SoFi is burning cash. So let's take a look at a couple numbers. Number one, the 52-week high was $24.64. 52-week low is $4. So a very crazy year. Looking at the max chart, you can see multiple times we're trading up around this high at 25, and then finally we've dropped down to those lows of 633, and even actually at 1.483, in which we have rallied. Now, if we look at some key numbers here, market cap $7 billion. So a very, very small company. And there's nothing wrong with that. There's nothing wrong with a small company, but it's just going to be inherently more risky. So a $7 billion market cap, company's only doing $1 billion in revenue. Net income is a loss of $416 million, which we're going to get to in a bit. There is no PE, and there is no 5-year PE. The reason there's no PE and no 5-year PE is because the company's not profitable. They can't have a PE ratio if there's no profits. Profit margin is a loss of 37%. So for every dollar they bring in, they lose $1.37 basically. So the company's burning through cash. Price to sales is 6.26. Obviously, there's no dividend because there's no money. So that's something to think about. But the company does have a lot of growth. And that's one thing I do want you to realize. So looking at the income statement from March 2022 to December 2022, one big thing you can see on this very limited income statement is that revenue massively went up 500% from 2020 to 2022, from 286 billion to 1.12 billion. It's absolutely insane. But if you look at the net income, which is something I talk a lot to you guys about, is that you have a loss of $74 million out of 286 million you did in sales. And now in 2022, you have a $416 million loss on 1.21 billion. So they're actually losing more percentage. Their net income is worse now, percentage-wise, than it was before. So if you think like 50%, right now it's what it is basically. We say like 35-40%. I'm not terribly good at percentages, but 1,400 million, that'd be 40%, 41%. 41% is what their losses are right now, really 37. It was way better than it was in 2020. So in order to grow a company, I understand that it takes a lot of money, but they're burning through cash very quickly. At the rate that they're going, and it's something I want you to realize. If they were to continue their growth rate from 2020 and 2022, by 2024, they would be doing $5 billion in revenue. $5 billion, and they'd be burning $2.5 billion. So that's not sustainable. The company has to focus on net income and then also generating higher revenue. So the current trajectory financially that they are on, it's not something that can happen forever, which is something I want you guys to understand. Yeah, they're growing heavily, but like they're just burning through cash, and that's not something that I personally want to be a part of. Now, looking at total liabilities versus total assets, you can see here that just looking very briefly, it's not too much to see. Total assets is 12 billion, total liabilities is 7 billion. So yeah, they could pay it off, but still, I can't get on a company that's just burning cash like that, especially in the market right now with how everything is at this point. I just can't do that. So let's just, I don't even know how we're going to go through and do this because the company's burning so much money, but let's try to figure out a stock analyzer, right? Let's just say, and I guess you could look at something like Wells Fargo or another bank because they are basically a bank. But let's just go with revenue growth in the next 10 years. Let's say on the low side, they're growing revenue by 5, 10, 15. I think that's generous as hell, but we'll keep that there. Let's say their profit margins are, you know, 3, 6, 9. Free cash is going to be something like 3, 6, 9. PE would be 15, 20, 25. I think that's even too much, 25. And then let's say that we're looking at desired annual return 15%, 15%. So that means for me to buy this company, I need SoFi at $1.63. $1.63. Yeah. I mean, even if you think they're going to do this, which I want to hear from you guys because I'm not a hater on SoFi. I just want you guys to explain. If you think that this can happen, 10 years from now, on average, this is an average, 15% revenue growth. They're doing 41% right now, which is nuts. But you have to remember, you can't grow a company like that in the future. Like, as the company gets bigger, it can't go putting those numbers up. Profit margins, positive 9%. They're positive 40%. Free cash flow, they're negative 247%. I'm saying 9% free cash flow. PE, 25. And price, yeah, I just... that would be $4. So for me, I'm passing. Not something I'm touching. It doesn't mean you can't make money. It doesn't mean it's not a speculative investment that could go somewhere. It doesn't mean that it might not get pumped back up to $12. I don't know. For me, though, I just can't go investing in it. I just can't go touching it where the current market conditions are at this point. But I hope I'm wrong. Let me know what you think. Comment down below. Maybe I'll be buying if we're at $1.10. Peace.